All right, greetings everybody. Welcome back. Happy Wednesday. Thank you for joining me again. It is Wednesday, which means it is time for another weekly Wednesday discussion. My name is Chris, and welcome to another presentation here. We're going to be covering the British pound today. This is going to be a fun one. It's going to be going down a little bit of a history lesson and giving us something to think about once again, other than some of the charts that we've all been staring at for the last, 72 hours, give or take at this point. Nonetheless, as we move forward, we must always go through our beautiful disclaimers. So let's go ahead and get that out of the way as quickly as possible. Not a single word of these has changed. So those of you that already know them by heart, well, guess what? This is not for you, but once again, required to do it. So we are here as we must be. Gonna need to make sure my my water is at hand for this one today, because I will be speaking quite a lot and continuously, because we're going down story lane. If you like a good story, well, hopefully you like the sound of my voice, because we will be diving into the long history of the sterling. We're going to be diving way back into it and working our way up to present day. And I might even throw up a little bit of a timeline. Move it along to the next disclaimer, by the way. But throw up a little bit of a timeline on a word pad after we're all said and done, to try to throw it all together a little bit easier for you. So some of you that are more visual spatial learners like myself, but this is going to be an interesting one. I've got a nice presentation prepared for you. And yeah, we will get a nice educational, historically accurate lesson on where the pound came from. Moving along. I do get excited when we get to do things like this, just because I feel that it breaks up some of the monotony of directly trading associated subjects, so to speak, which is very, very nice. Obviously, the British pound is tradable in both Forex and futures, so still very, very relevant to all of us here. But it gives us something refreshing to listen to that is related, while still being different enough that it's not, it's not making us feel a little bit overwhelmed by all of the same subjects. So I am excited for this one. Hopefully you are excited as well. Either way, ready or not, she's coming along for us. And moving along. This will be the last one. So congratulations, you made it. It's always a wonderful time in our lives when we get through these disclaimers in the beginning of the session, because that means we get to jump into what we're all here for. Unless you come just for the disclaimers, then, and then I guess sad days for you, but happy days for the rest of us. Happy days for the rest of us. That would be a fun thing there. Coming just for the disclaimers. Hi, here. I'm here to look at the disclaimers and nothing more. Hopefully, life takes all types to make the world go round. So moving along, here we are. So anyway, like I was saying, today we're going to be talking about the British pound. This is a fun one because we're going to be diving into the world of, the historical world of the British pound. We're going to talk about where it came from, or how it's gotten to where it is today, and where it might potentially be going, just based on some of the trajectories and kind of the momentum over the years, we'll say. So the way we're going to do this is we're going to switch on over here to, we'll do a little bit of that, a little bit of this. And this is going to be a nice little backdrop. This currently is the active chart for the British pound. Now, this is British pound futures. If you want to pull this up on your chart, this is going to be 6B. That is going to be the /6B. Once again, if you are looking to pull up the futures variation, if you're looking to follow the Forex chart, if you're one of my Forex traders, then obviously hopefully you already know the drill there. That's going to be GBP/USD, okay? pound dollar. So the pound futures is still tied to the dollar in terms of its valuation, obviously, but this is the pound futures in relation to the pound dollar. So it's basically pound dollar futures, just think of it that way. And this is a 15-minute chart at the moment. And you can already see that we've had some nice little moves along the last few hours, a few bullish pops, a nice few, little bearish pullbacks, some retracements along the way. And now we're struggling to break through a little bit of resistance going on near that 1.3065 area. Somewhere around here, we have hit a bit of a wall, having a little bit of difficulty trading beyond that location. This is an area that was resistance in the past as well as support. So we'll see if we have the pressure it takes to get through that. But what we do see at the moment is that the lows are getting higher and the highs have been getting higher progressively, and we've just kind of been grinding ourselves in this upwards wedge formation into this area of resistance, which generally speaking, the textbook would tell us this is one of those indications of pressure building, a bit of accumulation coming, the textbook tells us that this is one of the situations where we want to be on the lookout for a potential breakout, one way or the other, obviously, but it's self-explanatory at this point which way she's been pushing. But without further ado, I hope all of you have a nice comfortable chair. Maybe you got your drink in your hand, because we are about to dive on down to Conversation Street, and we're going to dive into the pound. So get your coffee ready, get your drink ready, because here we go. So starting off, we'll talk about the birth of the currency. We'll talk about the birth of the British pound, and we'll work our way forward relatively quickly in terms of how far we're going backwards till, obviously present day. We're going to skip a few hundred years along the way. But the birth of the currency, it's an old currency. The pound itself is. It's 1,200 years old, so a little bit older than you or I. It was born in somewhere around 775 AD when sterlings, quote unquote, or silver pennies were the main currency of the Anglo-Saxon kingdoms. So once again, that's where the British pound, the sterling name, comes from, because it was a silver penny, so to speak. If you had 240 of them, you would have had 1 pound in weight. So there comes the name, the pound. So 240 of these silver or sterling pennies would have created a weight of 1 pound. Now, a vast fortune in the 8th century, this would have been considered. A pound would have been quite a large sum of money. So inflation only brought one into many people's grasp in the 17th century. The pennies were coined to keep Viking raiders away by paying protection money, or Dane Geld, okay? A century and a half later, Athelstan, the first king of England, founded a series of mints across his newborn nation, unifying the output in the Statute of Greatly in 928 and founding sterling as the national currency. Now, strangely low, the name sterling, it took a while to appear. The first mention, Sterling, let me get my speaking voice properly. Sterlnesis in 1078 is from the days of William the Conqueror, who also introduced the shilling, okay, which is 20 to the pound, into his new kingdom. The name only became commonplace in the 13th century. So its origins are lost to time. Stars and starlings both appeared, and I am saying that correctly once again, that is starlings. They both appeared on minted pennies or sterlings, but no one knows if either gave their names to the currency itself. The Easterlings, or early medieval merchants and money changers, are another possible source of the name. Either way, the name stuck, linked to the meaning of stir in Old German, which is strong, pure, stable, reliable, or excellent in terms of synonyms. English silver was held in esteem, and that respect was worth keeping. So value was once again added and held around because of the essence of the desire for that silver and where it was actually coming from. So in 1124, a disgusted Henry had minted 94 mint workers, so to speak, had 94 mint workers castrated for producing bad coins. Not a great time to be alive. This might have been well before some of those unions that you and I might be favoring nowadays, right? Nonetheless, so 94 mint workers were castrated for producing bad coins. Nicholas Mayhew wrote in Sterling, The Rise and Fall of a Currency, okay, that it was, and this is I quote, it was the earliest and certainly the bloodiest of a series of attempts which were to take place over the centuries to restore confidence in sterling. So sterling retained importance through the Middle Ages. Before the foundation of the Bank of England, that is, the Tower of London was the store for spare money. So if there was ever to be a good raid, the Tower of London would have been where you wanted to go. Silver pennies were the only coins right until the 13th century. So up until the 13th century, it was silver coins only throughout England, and silver was the currency standard until the 18th century. So once again, skipping quite all the way farther ahead until the 18th century, when gold became the basis of the pound. So it was in the 18th century that we switched from the silver base to the gold base. Now, the Bank of England and paper money will be where we're diving next. So in 1694, King William III, King William III established the Bank of England to fund his fight with France. Goldsmiths had issued banknotes, which were promises to pay set against gold deposits. Now, from the 16th century, this is when the banknotes were created, but although the Bank of England was the first central bank in history, it has not always had exclusive control over the pound. Banks in Northern Ireland, Scotland, and Wales printed notes along with satellite banks, but only those more than 65 miles from London. Crime arrived quick on the banknote's tail, however, and made things a bit more interesting. By 1695, the first fraud happened. This is obviously when we're starting to get into more of the advent of fraudulent creation of some of these notes, and led us to where we are today with so much technology actually derived into many monies of the world. The authorities fined one Daniel Parismore for forging 60 100-pound notes, which was a lot of money in the late 17th century. Once again, 60 100-pound notes in the 17th century. Quite a lot of money indeed then. The bank introduced a watermark to stop the fraud, and the Crown introduced the death penalty for counterfeiting. So basically, the Crown simply said, you forge our money, we'll take your head. All right. The bank provides stability, but the pound still suffered from market ups and downs. The first £10 note, I'm so Americanized, it's ridiculous, but the first £10 note was printed in 1759 when the 7 Years' War caused severe gold shortages. Inflation fears of war with France led to the first £5 note in 1793. That same Republican threat caused a series of runs-on with the bank in 1797, ushering a period of fiscal restriction which lasted until about 1821. About then, the Irish playwright Richard Brincelin Sheridan angrily described the bank as an elderly lady in the city. And once again, I quote, an elderly lady in the city was the description given to the bank. The name stuck. The bank became the Old Lady of Threadneedle Street, nicknamed by the cartoonist James Gilray. Sterling banknotes were originally handwritten, although the notes were part printed from 1725. Cashers still had to sign and make the notes out to somebody. The bank themselves began to print notes in 1855, no doubt to the relief of their workers. Now, as we move along to the gold standard and sterling supremacy, we'll learn a little bit more about where we continue to progress into the 19th century. So from 1717, the UK defined sterling's value in terms of gold rather than its original silver. But it was not until the 1870s when Germany adopted gold that the gold standard came about, ushering in an era of grand scale of international trade. The principle of the standard that a nation must back its banknotes with the equivalent in gold established exchange rate stability, so it was thought to be a very good thing for the world. Sterling's strength was the basis of the gold standard and was behind a sustained period of global growth right up until around 1914. So we had a large period of growth up until right around 1914 where gold was helping the economy boom with the standard being changed over from silver. But by the 19th century, government's success rested on the disenfranchising of working classes. Modern democracy would not let governments ignore exchange rate pressure, so that the gold standard was a unique period in economic history. While it reduced exchange rate risk, stability based on gold helped British investors and traders. Global finance took off, ushering in an era of gentlemanly capitalism, as we could call it, when British investors poured money into offshore investments, protected by the immense strength of sterling and the might of the British Empire. So if British ruled the waves, sterling was the global economy's lifeblood. But the gold standard also had a downside. While prosperity passed rapidly around the world, so did the business cycle and the financial panic. The collapse of the American rail building boom after the East and West Railways met in 1869 caused a bad depression from 1873. The 1890s and the 1900s also suffered severe depressions, all at the speed of the telegraph wire. And the outflow of the capital reduced Britain's productivity in the long run because of the unavailability for British industry, and contributed to a lengthy and slow decline in the sterling's face value. So it was around this time, around the early 1900s, when we started to see a slight drawback in certain degrees. So as we worked our way towards that World War I era, which some of you might already be a little bit more familiar with because we're getting a little bit closer to common time, so to speak, the UK suspended the gold standard that we change, or that they change, I should say, that they changed their currency's valuation to, instead of the sterling, instead of literally the silver itself. They suspended the gold standard in 1914, bowing to the necessities of wartime, okay? Wartime manufacturing caused inflation and helped enliven trade unions within the Treasury rather than the Bank of England. And we printed, or the Bank of England themselves, I keep saying we, but printed banknotes itself during the war years. So the Bank of England during the war years was printing the notes themselves. After the war, Britain sought to return to its former preeminence, ignoring the consequences of the war. Winston Churchill, we all know, returned sterling to the gold standard in 1925 at the pre-war rate of $4.86 to the pound. Once again, so $4.86 to the pound. In terms of the valuation, 1 pound was equal to right around $5, just underneath. However, the pound was overvalued by 10%. The rate of exchange for sterling had been unchanged since Sir Isaac Newton set it in the 18th century, when he was the master of the mint. The value was very out of date indeed. Growing labor militants after the war made undemocratic economic goals and overvalued pound issues much harder to justify. Sterling's expense hurt the British economy. So as we continued to move forward, we saw the end of the gold standard. So the dollar's growing dominance, that's here in the US, of course, the dollar's growing dominance began to reduce sterling's importance as a reserve currency, while sterling remained overvalued. By the end of 1925, the economics of the coal industry had collapsed, and 1926 brought not stability, but a 6-month coal strike, the general strike, and a long drawn-out unemployment. The economic slide culminated in an irresistible run on the sterling in 1931, effectively ending its roll stint in the gold standard. The standard broke down globally between 1930 and 1933 under pressure of slump, excuse me, and the huge cutbacks in lending, which led to an era of economic protectionism and limited international trade. The pound remained afloat until 1939 and the outbreak of World War II. World War saw a great increase in forgery as Germany Nazi government tried to weaken the sterling by spreading counterfeit notes. By 1943, the Germans were producing 500,000 banknotes a month, and all the majority fell to the Allied forces as they advanced into Europe and were destroyed. For years afterwards, fake pounds were causing major headaches for the Bank of England. To counter the fraud, the bank introduced the metal thread during the war to differentiate its issue from Germany's and stop producing some of the higher denomination notes. So as we moved along in time to 1944, the Bretton Woods Conference in 1944 heralded the end of sterling's predominance in international trade and the triumph of the American dollar. The agreement defined both the dollar and the pound as reserve currencies, a sop to British pride rather than a reflection of the truth, ignoring the UK's very large balance of payment deficit caused by the war. That reserve status meant that other nations must accept dollars or pounds to settle debts. But each country, including Britain, would define the value of its currency in dollars, and the US would tie the value of the dollar itself to gold. The world simply did not have enough gold for every currency to hold reserves. In theory, there was still a link to gold to impose a discipline on the system. The Americans held their currency stable against their gold reserves in the famous Fort Knox, and oh boy, what a famous Fort Knox it was. But the pound was not a popular reserve currency. Although the Commonwealth sterling bloc helped to retain some importance in the currency markets, after the war, rumors swirled that sterling was to devalue, and so many countries converted their pounds to dollars. So we started to see a continued devaluation of the pound as people began feeling more confident in the dollar itself. And these are the type of things that cause a valuation decline in the pound, and these are the types of things that we want to pay attention to as traders, because obviously as things like this occur, we're expecting a value drop in something, and if we know that something's going to drop or rise, obviously as traders, that is something that can be potentially profitable for us. Okay. At that same time as converting all those pounds to dollars, Britain's trading partners in the sterling bloc, mostly her colonies, wanted consumer goods, which the UK could not supply. The UK was still geared for war supply. These nations turned to the USA and dollars for their consumer necessities, further weakening the British economy, and by 1949, sterling's importance as a reserve currency was severely on the wane. Sir Stafford Cripps, then Chancellor of the Exchequer, accepted this uncomfortable fact, although he denied it in public. The pound was devalued by 30% on September 18, 1949. The enormous post-war balance of payments deficit was just too much for the UK. Lend-Lease and debt due America had taken its toll. Sterling's weakness and decline had become glaring. National banks wanted those dollars instead of the pounds as the landslide continued. Okay. So sterling's role as a pegged reserve currency made the UK's exports uncompetitive. Its excessive weight reduced exports and led to a manufacturing slowdown while the US boomed. The constant seepage of reserve from pounds to dollars continued to weaken the sterling. In 1967, Labour Prime Minister Harold Wilson and his Chancellor of the Exchequer, James Callaghan, devalued the currency again, this time by 14.3%. Harold Wilson made his famous pound in your pocket speech, quote unquote, in an attempt to reassure the public about their wages. But his words were not they were not taken as he intended them. His words were cruelly twisted by the Tories and the press to mean devaluation would not entail a rise in prices. After all, life did become more expensive. Although in 1949, devaluation helped Britain's exports, the same was not true in 1967. The domestic inflationary forces arose. To combat these, the government reintroduced charges on NHS prescriptions, abolished free milk in secondary schools, and postponed raising the school leaving age to 16. So in an attempt to change and fight some of these inflationary tactics, we started seeing some changes along those lines. The welfare state also took a step backwards, but long-term economic decline and imbalances in the British economy rendered these measures valueless. Overseas, the sterling currency bloc creaked towards lesser importance, and the pound's devaluation brought in the Bretton Woods system of fixed exchange rates itself. Dollar was more alluring to many, and that's the US dollar, of course, and as many thought at the time, they viewed it as a more stable currency. But in 1971, President Nixon devalued the dollar, a response to damage done by the Vietnam War, and opened the gates to a new era of floating exchange. The stability of the post-war settlement was over. War in the Middle East, high oil prices, and international recession combined with the UK's slow economic decline struck a hard blow. By 1975, the face of inflation and a large-scale coal miner strike, the UK had to apply red-faced for a loan from the Monetary Fund internationally. Now, meanwhile, the first tentative steps towards a European currency were taking place. 1972 saw the first efforts to fix the pound to other European currencies. At the start of the year, the major European Economic Community, which we know as the EEC, sterling Dutch mark, the French franc, and the Italian lira formed the so-called snake. Okay, the economic bloc then floated their currencies together on the markets, each country having responsibility for the stability of its currency within parameters. The experiment failed, though, not long off the ground. Sterling dropped out only after 6 weeks, weaker than ever, bowing to the dictates of the markets. Currency markets were just too volatile to fix exchange rates together without damaging the British economy. Okay, in 1976, we saw the pound fall below $2. That's $2 for the very first time. The government's approach to the International Monetary Fund, which is the IMF, to shore up sterling's value. The IMF loan included a letter of intent, a humiliating agreement to pursue stable economic policies, and the pound gathered some strength by the end of 1977. So we saw a little bit of positive growth here at the IMF, despite the overall hurt. But by the end of 1977, the government had abandoned the efforts to keep the pound within the trade-weighted index. Sterling was too strong again. Callaghan's Labour government had to move to control the monetary supply. Okay, moves to control monetary supply were in place before Miss Thatcher came to power in 1979, but her government put much more stall on monetarism. The dollar's growing strength overshadowed the pound's rise in value in the late 1970s and the early 80s. Central banks around the world intervened to prevent the dollar becoming too strong, and by 1987, the dollar was at what bankers saw as the quote-unquote correct value, so decided at the Laver Accord. Nigel Lawson was Miss Thatcher's chancellor at the time. He decided to cap the pound against the Deutschmark, inspired by the growing European integration. The pound would not exceed 3 Deutschmarks. This policy, Lawson believed, would bring Britain's competitive and inflationary pressures into line with Germany. But Europe at the time was growing slower than the UK, a condition then known as Eurosclerosis. The result was massive capital inflow to Britain. Sterling rose as investment then flooded in. Lawson had to remove his cap, but by then it was too late. Inflationary pressures had taken off, consumer spending was at very high levels, and the housing market booming. To rein in these pressures, the interest rates did then go up, but the property market and consumer spending then collapsed. The UK was in recession by early 1990, and sterling on its way down yet again. Okay. Lawson's successor at 11 Downing Street, John Major, had to reduce the UK interest rates and so encourage a revival of the British economy. He decided to join the exchange rate mechanism, the ERM, and as such, we saw some changes. Interest rates in Europe were lower than in Britain. Sterling joined at £1 to 2.9 Deutschmarks, March the same rate as Lawson's cap, but Major was hoping for the inflation which Lawson had not wanted. ERM rules dictated that the pound was to be no more than 6% from its entry rate and 3% from either side. And the idea here was to reduce the UK interest rates by linking them to Germany's at 8% rather than the UK's 15%. But the Dutch mark strengthened over the next 2 years, Germany boomed, and the UK slipped further into recession. The fixed strength of the sterling, maintained with ERM's limits, hit British exports hard, and the major government's desperate pleas to the Bundesbank to lower the interest rates and so weaken the Dutch mark went unheeded. The Germans were unwilling to shift policy because they were suffering the inflationary consequences of incorporating East Germany. One particularly painful episode took place at the Bath meeting of the European financial ministers in 1992. The UK was EU president at the time. Excuse me. At the summit, Norman Lamont, Major's successor as Chancellor of the Exchequer, berated the Germans over their interest rates, lecturing anyone who would listen about the faults of Germany's exchange rate policy. And in the meantime, George Soros, the American financier and currency speculator, decided that sterling was overvalued and gambled heavily against the pound, selling the sterling for Deutschmarks and British securities. His gamble paid off. Although the conservative government had vowed again and again that sterling would not leave the ERM, the sale of pounds on the currency market made any effort by the Bank of England to buy sterling back to strength redundant. By this stage, Soros, alongside other speculators, controlled a hedge fund of $10 billion, little less than Mr. Lamont had to throw into the currency, and the bank was running out of reserves. On the 17th of September 1992, a somber Mr. Lamont announced that the pound was to leave the ERM and devalue. He shifted exchange rates from 12% to 15% on that one day, but his attempts to bolster the currency came to nothing. The pound devalued, and Mr. Soros, rumored to have made as much as $2 billion in his bet against sterling, was christened the man who broke the Bank of England by the Daily Mail. The day was known as Black Wednesday or White Wednesday for UK's growing contingent Eurosceptics. John Major said afterwards, it was a disaster, a political disaster. There is no doubt about that. It was an embarrassment for the United Kingdom. Sterling was back on the free market. And as we move towards today, the ERM today, excuse me, folks, sorry about that. I haven't taken a drink in a minute, and it's starting to crack my throat. But as we move back towards today, since 1992, the pound has floated free, although the government has tried and succeeded in maintaining an inflationary rate broadly in line with Europe. In October of 1992, this target range was initially set at 0 to 4%, but later revised to 2.5% with a 1% band on either side by Tony Blair's new Labour government. This is a remarkable achievement given how prone the UK is to inflation and appears to herald a new economic convergence with Europe and maybe a new currency, but it remains to be seen whether the euro will herald the end to the world's oldest currency. And that, my friends and family, is one of our oldest currencies as we possibly watch it near its end. Although many would argue that it still will remain in one fashion or another. So that is the history stating all the way from the back till present times with the pound. And what I thought we should do is take a look here at, let's see here. I'm pulling up a chart for you all to show, let's see, there we are. We're going to look at a chart using a wonderful little piece of information here from the website macrotrends.net. If you are interested, this is where this is coming from. So this is the pound dollar exchange rate. Once again, this is the GBP/USD historical chart. And this is an interactive chart showing the pound all the way back to 1971. And something that's pretty cool about this as we go back, now granted, we started our talk today quite a lot farther back than that, but as we go back, all the way back over here to 1972, February 28th, we'll notice that on all the years that we currently have data for on this chart, that we were all the way up here at a valuation of almost $2.6 for the pound in relation to dollars being, if you were to buy a pound with dollars, it would cost you $2.6, right? So the chart here is showing some of the points in history that we were just discussing, okay? Here in 1977, obviously, we had a very interesting time that led to a sharp devaluation, and then again in, obviously, 1985, which I was thinking about throwing you guys a bit of a timeline here to kind of plot out all these points along the way. I don't know if we'll have all the time to do that now that I'm seeing where we're at in time, but nonetheless, the general consensus here that we can see with the British pound is despite its valuations where it did find times to recover during certain economic periods, we have undeniably exhibited a downtrend in the last 40 to 50 years. Undeniably, we have seen valuation drop. It's not a good trajectory, and it's not good momentum overall. So despite always having times for the market to rise, we're seeing kind of a return to normality or more of an equilibrium being reached across the market, whether or not we see the pound completely disappear altogether and be replaced by perhaps the euro or anything along those lines. What we are seeing is a less of a disparity between the pound and other currencies as had been held for so many years. And that is something that is worth noting for those of us as traders, because if we are aware of long-term bearish pressure and long-term bearish decline, we might want to consider that if we are ever trying to go long on a long-term investment, something that is affected by the pound, okay? So that is something, once again, to be aware of. I also have, let's see what we have here. All right. I had a chart that we initially were looking at while we were discussing this on 15 minutes, and I thought, why not switch it out to as far back as the Finemark charts can let us go, which is going to be down here. We'll work our way down. Actually going to be a daily chart. There we are. I'm sorry, a weekly chart. There we are. So switching our way down, just let me scroll down the screen. So here we are. We have a weekly chart where every single candlestick on the screen is representing a week. Now this is fun because this is going to show us a few years of information when we start scrolling outwards. So if we just take a peek here, okay, the farthest back our Finemark charts are going to let us go on the data feed is going to be 2011. For all intensive purposes, generally speaking, that is going to be quite far enough for any of us. We're going to be looking at a period of, quite a few years here. Most of us are interested only in the last few months, let alone the last few years, let alone over a decade of information. So, but the interesting thing to note here, though, is as we go back to 2011, what did we see? Well, we saw a bit of a consolidation period. We saw the market rise and fall, deciding if it was going to fall lower. Then we saw a break in support that was pretty important here because it foreshadowed what would happen should we fall back down to this point after we went for an all-time high up here at the 1.7. And when I say all-time high, I'm just saying relative to the chart we're currently looking at. So we went for our all-time high, but because support was already broken, we found a very easy time breaking and setting a new all-time low, which then led to a very powerful bearish decline. So those that were seeing this type of behavior in 2014, at the end of 2015, they were ready for a very hard sell, which led until roughly around 2017, about halfway through the year when we started gaining some strength yet again. But this was a very powerful note for anybody that was trading the pound because of the break of support over here on the left. But these are very, very high time frames, and sometimes we miss this kind of stuff. And it's very common in trading that I notice with a lot of our traders here that we lack the drive to always pay attention to the higher time frames because things react so much more slowly. But this information can be incredibly valuable to us as traders because it can keep us on the right side of the trend. Now, on the intraday scale, there was obviously many bullish days and many bearish days along the way, but the overall consensus and the overall momentum would have carried bearish moves overall, just in theory, harder down than obviously going up if the overall momentum has taken us downwards and not upwards overall. So this is something where we can say, all right, we're only going to stay on the side of shorting, and that information alone is already going to put us up beyond that 51% coin, so to speak, theoretically. Meaning we're taking, and I'm using that as an example. I'm not saying that as a literal statistic, but I'm saying the idea here is if the market is falling more than it's rising and we're selling, that's generally a good concept. That shouldn't be hard for anyone to understand. But by paying attention to the higher time frames and the history and what is going on in the markets, knowing some of these changes and these events and paying attention to some of these world newses can keep us on the lookout for what to expect in the coming months. And sometimes it doesn't have to be all that overly difficult to interpret or understand. And a lot of times the interpretations and the information is already done for us. We just need to do the work in understanding and reading the logic behind some of these interpretations as they're coming out with new currency plans or economic information regarding, the UK and what have you, or perhaps, Brexit or anything along those lines. As we know, Brexit was not ideally a very good thing for many traders in general, except for those that were taking advantage of some of those powerful shorts that occurred off of it. But nonetheless, paying attention to some of these things can prove to be very profitable for us just by paying attention to these longer term trends and the anticipation of how the next few months or maybe even the next year should be going based on larger economic plans. And by doing that and keeping ourselves only looking for longs in that type of a scenario, we can already be increasing our odds to be pulling profit just with that. So there is value in understanding what's going on with these countries and understanding the history of them and how the history impacts impact the currency, because then we can be on the lookout for events like that are going to occur in the future and expect most likely a similar outcome. If it happened the past one way, there is a good chance that in the future, the same type of event might cause a similar reaction in the currency. But nonetheless, folks, it has been a pleasure as always. I hope you enjoyed the journey down into the history of the pound. I enjoyed giving it to you guys. It's always fun to talk about stuff like this and learn something new. It keeps that brain fresh, keeps it stimulated, and that's always the goal here. So thank you for joining me yet again here at Earn to Trade. My name is Chris. I'm a trader and presenter and educator here at Earn to Trade, and I appreciate all of your ears. It gives me someone to talk to, and other than obviously all of you that I'm talking to on an individual basis, but it gives me an audience to share information that I get passionate about. So thank you very much, everybody. I appreciate you showing up as always. And I hope you have a good rest of your day, a good trading day, and a good rest of your week. The weekend is closely approaching, so something to celebrate there for you. Close this week out strong, guys. Stay on top of that market. I will see you all very soon. Over and out.